Welcome back. You're tuned in to Buy Now Sell Now. We're getting you all the movers in trade today, and let's talk about another earnings candidate, Sanghvi Movers, that is moving up in trade with gains of 1.3% in the back of its Q4 results. We have a good set coming in for Sanghvi. In fact, if you look at the numbers, we do see an uptick of 28% on the profit on a year-on-year basis. The revenue is also traded up 31% at 351 crores. The EBITDA was up 25% at 133 crores, and of course the margins also saw a bit of a decline coming in. But let's get the management on board and speak to them about that. Rishi Sanghvi is the MD of Sanghvi Movers, who's now joining us. Hi, good morning, Rishi. Thank you so much for joining us today.
Good morning. Thanks for having me, Kavita and Ankita.
Right. Rishi, firstly, the company has reported a strong growth annually and quarterly. How sustainable is this rate of growth, and what drivers will ensure that this trend continues in FY27 as well?
First off, we are extremely bullish with what is happening in the economy. There are strong signals from every sector. We have started the year with an order book of nearly 1,050 crores at the start of the year. So we see that there is tremendous demand, and we believe that we will grow at the same rate that we grew last year. We will grow in FY27 at the same rate.
Company has outlined a Capex plan of 391 crores for FY27. What will be the specific avenues for capital allocation in this plan?
So last year, the board had approved a Capex plan of 640 crores, of which we executed 500 crores. There is a spillover of 120 crores. And in addition to that, we will execute another 390 crores. So that takes the total to almost 510 crores for this year. Now, this Capex will be split equally between our core business in India for crane rental business, and the balance of the Capex will be allocated towards the Middle East for the crane rental business in Saudi Arabia and Qatar.
Right. Also, the EBITDA margins saw a bit of a contraction, like I mentioned at the start, on annual and quarterly basis as well. What are the key reasons behind this, and what would be your margin outlook going forward?
So specifically, in absolute terms, the EBITDA has gone up. Our revenue share has been increasing from our engineering and construction business, which is Sanghvi Future Renewables Private Limited. The top line has grown to almost 500 crores, adding to our 57 crores of PAT at the bottom. Now, this is a low EBITDA, high return on capital employed business. So we nearly have a ROC of about 75% there. So at a group level, absolute EBITDA stands stronger than last year, although the blended EBITDA margin has come down. At the crane level business, we continue to sustain margins in the range of 53% EBITDA. However, the E&C business, which, as I mentioned, is a high ROC, low EBITDA business.
Current order book stands at 1,053 crores. Can you throw some light on the execution timeline and the further order pipeline in place?
So 1,053 crores is entirely executable in this financial year. There may be some slippage in the execution timelines due to external delays of about 10 to 15% of the order book, which is what we're seeing in the renewable business. And currently, we are sitting on an inquiry pipeline, which is almost 4 times our existing order book.
Also, the company has reached 79% capacity utilization in FY26. What is the anticipated utilization level for FY27?
So we believe we will sustain and, if not improve, the utilization levels from 80% going forward based on the strong order book visibility. One thing which is interesting is in the GCC, our overall utilization is more than 85%. And going forward, we have a strong inquiry pipeline and, as well as order book in both Saudi Arabia and Qatar. So we are positive to maintain utilization levels above 80% in the coming year.
Do you foresee the renewable segment occupying a larger portion of the overall revenue going forward?
We believe that the renewable segment will contribute significantly, not only to the top line, but the bottom line as well. The renewable arm builds a defensible moat for our crane rental business because it gives us substantial crane rental revenue from Sanghvi to Sanghvi Movers. What is worth noting is we are still deploying 500 crores of Capex, and the entirety of this Capex is for our core business of crane rental. And this business is on track to grow substantially this year.
Right. Also, talk to us about any impact that you would have faced on account of the West Asia crisis, and how are you planning to navigate through that?
So the ongoing situation in West Asia is something that we continue to monitor. However, we are still extremely bullish in our initial hypothesis of expanding into the market. In the peak of the situation, we were maintaining a utilization levels of 90%. Our yields, in fact, improved during that time. And going forward, we have a strong inquiry pipeline of almost $50 million for the next 24 months. So we are doubling down in the region. We will be deploying approximately 200 crores this year in terms of capital investments for the Middle East, and a spillover of 120 from last year. So this year we are on track to execute 320 crores of Capex to purchase brand new equipment for the region. And our inquiry pipeline, order book, yields, and the current sentiment in the region all support our hypothesis to double down in the region.
All right. Any specific reason why this was a strongest seasonal quarter for crane rentals and logistic sector? Could you explain that, please?
Typically, Q4 is our strongest quarter because most companies want to hit execution timelines prior to the financial year end. So historically, Q4 has always remained our strongest quarter. I think what has happened in this quarter is that we have become laser focused on execution. We are converting our inquiry pipeline, and we are delivering tremendous value to our customers. Therefore, you see yields going about 2% and utilization remaining above 80%. Early indications for this financial year, based on our opening order book and inquiry pipeline, which is to the tune of 1,000 crores on the order book and almost 4 times that on the inquiry pipeline, indicate that going forward, this growth remains sustainable, and we are positive for the FY27.
All right, Mr. Sanghvi, on that note, thank you so much for taking the time out and joining us. It was a pleasure to have you on the show.
Thank you, Kavita, and thank you, Ankita.